Imagine you could bet against every professional money manager on Wall Street and win 90% of the time. Sounds impossible, right? But that's exactly what a simple index fund does. Over any 15-year period, about 90% of actively managed funds fail to beat the market. Let's understand how index funds work and why they are almost impossible to beat consistently. Index fund is a type of investment that simply tracks a market index, like the S&P 500. Instead of hiring analysts to pick stocks, it just buys every stock in the index in proportion to its size. Think of it like a basket. The S&P 500 index fund holds a slice of the 500 largest American companies. When you buy one share, you instantly own a tiny piece of Apple, Microsoft, Amazon, and hundreds more. The key innovation was passive management. In 1976, John Bogle launched the first index fund at Vanguard. Wall Street laughed and called it Bogle's folly. Nobody would settle for average returns, they said. But Bogle understood something profound. The stock market is a zero-sum game before costs. For every winner, there must be a loser. And after fees, it becomes a negative-sum game. Here's the math. All investors collectively own the entire market, so the average investor must earn the market return before costs. This is not an opinion. It is arithmetic. Now, subtract costs. Active funds charge around 1% in annual fees. Index funds charge as little as 0.03%. That difference compounds brutally over time. Let's see what a 1% fee difference looks like over 30 years. Starting with $100,000 at a 7% annual return, the index investor ends up with over $760,000. The active fund investor? Only $570,000. Fees ate nearly $200,000. The data from S&P's scorecard is devastating. After 1 year, about 60% of active funds underperform. After 5 years, it rises to roughly 80%. And after 15 years, nearly 90% of professional managers fail to beat the index. And it gets worse. The few funds that do outperform in one period almost never repeat. Past performance truly does not predict future results. So why can't the professionals win? 3 powerful forces work against them. First, fees and trading costs create a constant headwind. Every trade has a cost, and active managers trade frequently. Second, markets are highly efficient. Thousands of brilliant analysts compete for every edge. When new information arrives, prices adjust in milliseconds. It's incredibly hard to know something the market doesn't already reflect. Third, there's the paradox of skill. As the average skill level of fund managers has risen over decades, the gap between the best and worst has shrunk. When everyone is excellent, luck dominates over skill. Even Warren Buffett, perhaps the greatest investor of all time, recommends index funds for most people. In his 2013 letter to shareholders, he instructed his estate to put 90% in a low-cost S&P 500 index fund. He even made $1 million bet against hedge fund manager Ted Seeds that an index fund would beat a basket of hedge funds over 10 years. Buffett won convincingly. The index returned 125%. The hedge funds returned only 36%. How to actually invest in index funds is simple. Choose a broad market index fund, like one tracking the S&P 500 or the total stock market. Look for an expense ratio below 0.1%. Invest consistently, whether the market is up or down. And most importantly, don't try to time the market. Let's see the growth of $10,000 invested in the S&P 500 over 20 years, from 2005 to 2025. Despite the 2008 financial crisis and the 2020 pandemic crash, patient index investors saw their money grow to roughly $64,000. Here are the key takeaways. 1. Index funds give you instant diversification at almost zero cost. 2. Costs are the most reliable predictor of future returns. Lower fees mean more money in your pocket. 3. Time in the market beats timing the market. And 4. Even the world's greatest investor recommends index funds for most people. The greatest financial invention for ordinary investors isn't complicated. It's beautifully simple. Own everything, pay almost nothing, and let compounding do the rest.